Afternoon all, it's Jamie here. Today I'm going to be talking with you about the difference between negative gearing and positive cash flow as property investment strategies. I'll go into my personal opinion a bit later on, but for now we will go through both negative gearing and positive cash flow. So what is negative gearing to start off? So negative gearing is where an individual's net income from an investment is lower than their expenses. For example, your rental income cannot cover the cost of your repayments and any maintenance costs and real estate fees. This always results in an investor being out of pocket for the costs of the property. How much varies location and interest rates. So we've got an example here. What is negative gearing? Bob pays $20,000 per year in interest on an investment property. He only gets $10,000 back from renting it out, which means there's a shortfall of $10,000, which has to come out of Bob's pocket. The good thing about negative gearing is that the shortfall that you pay is taken off your taxable income. It's offset. In this case, Bob earns $85,000 per year, and so the $10,000 he has to cover is taken off, which means he only has to pay tax on $75,000 at his rate, which may be different depending on your tax bracket. So we just got a case study here. Josh buys a property for $400,000 and takes a loan out for $350,000 at an interest rate of 5%, which is high now with interest rates going lower, but yes, it's relatively normal interest rate, I guess. The per annum interest equates to $17,500. This does not include any maintenance fees or real estate fees. Josh charges $300 of rent per week, which is quite low considering a lot of areas in Melbourne now are pretty high. And that adds up to $15,600 annually. So obviously you want to calculate the difference. You minus how much you make versus how much the cost is, which is $15,600 minus $17,500, which leaves you in a shortfall of $1,900. Josh will have to pay this out of his own pocket, out of his own earnings. But it will get deduced at tax time. For this sake, we'll say Josh earns $100,000 per year. He'll only have to pay tax on $98,100 for the year. So we'll just go into the pros of negative gearing. Long-term capital growth is the main aim of negative gearing, seeing as you're going to be in a shortfall for a period of time. You would hope that the long-term growth of the property offsets that. You don't want to buy in an area where there's no capital growth, because then you will have no wealth creation at all. Its long-term growth is dependent on a number of factors, including location. It's probably the biggest one. Market fluctuations, including interest rates and just demographics. Older couples might like certain areas. Younger people might be more prone to buy in an area or invest in another area. And probably the most known benefit of negative gearing is the tax deductions. So any out-of-pocket costs that you pay will be offset against your taxable income, which I don't know what you guys' income is at the moment, but it could be a significant amount depending. Negative gearing is a good way to get into the market. With Melbourne's property prices at the moment being so high, it's actually the only option to get into a well-built area, unless you're looking to go more regional or rural. But yeah, the tax deductions I don't find too appealing. At the end of the day, you're still running the property at a loss, which means you're still having to pay money until obviously you sell your property and you get the capital growth out of it. So the cons of negative gearing. So I've named a few already. Investors who are using a negative gearing strategy are required to pay expenses out of pocket. This can reduce your current cash flow from your earned income from your job, say, or other investments. It doesn't enable you to further your portfolio because you're paying a lot on one property. It actually doesn't allow you to use money from that asset to buy more and build your portfolio. It relies heavily on capital growth. So if your area does not experience long-term growth where you buy, you're essentially not creating any wealth for yourself. You might be going into negative equity, especially if the markets continue to fall back. But yeah, this is a strategy that relies heavily on growth over the long term. Market fluctuations can put you worse off if you're already negative gearing. Same goes with cash flow positive as well. A hike in interest rates will see your payments go higher and you could be paying more out of pocket. So going on to positive cash flow, obviously the opposite to negative gearing. It is where your rental income exceeds any of your expenses, including repayments, maintenance fees, and real estate fees. Cash flow properties are generally higher in rental yields than most places, and they're generally not prone to capital growth. So you find a lot of these properties in rural or regional areas. I know a few areas have high yields there, and houses cost very cheap compared to CBD Melbourne. But this isn't the case for all properties. As I stated before, you can find a very good property that sits in the middle, has a good range of capital growth, and has a good cash flow as well. My opinion is that cash flow positive is the way to go, or positive cash flow is the way to go, because you're getting money into your pocket. Sure, with negative gearing, you can get a lot more money in your pocket in a lump sum at the end of when you decide to sell your property, but this is a flow constantly making you money. So yeah, we'll use Josh for the same case study, but for positive cash flow. Josh buys a property for $400,000, but this time Josh has saved more money for a deposit. His loan amount now comes to $280,000 at the same interest rate of 5% per annum. That equates to $14,000 in interest, roughly, without any maintenance or real estate fees. Obviously, this could be a lot higher. Josh will charge the same amount for rent per week, which means he makes $15,600 from the rent per year. And we do the same calculation as before. 15,600 minus 14,000, which equates to $1,600. That means Josh has gained that from his investment annually, which may not seem like a lot, but any cash in in your pocket is better than anyone else's pocket. You will have to pay tax on any gains you make from an investment, which is at the marginal rate depending on which tax bracket you end up in. You may end up a bit higher depending on how many investments you have, or you may end up lower if you have negative gearing, obviously. So going to the positives of positive cash flow. Cash flow increases your income. As simple as that. So your investment is making you money. It's not making you liable for anything. This further money can be used to invest in more properties or other investments and can be used to generate more wealth. Investors aren't out of pocket for anything. That's probably the big thing. Reduces your stress amazingly. Like, it just takes all this weight off you. You don't have to worry about forking any out-of-pocket costs because the property in essence pays for itself. And any money you do make, again, will get taxed. Equilibrium. So cash flow positive properties tend to balance out well with negative geared properties. So if you have a negative geared property and a positive geared property, you hope that they cancel each other out. One, you're paying for the same amount as the income that's being brought in. And again, cash flow positive investments give you a peace of mind. That's probably the main thing. The cons. Positive cash flow properties may not be attractive to many buyers. As I said, a lot of positive cash flow properties are either rural or regional, and you can find some still CBD. You just have to do your research. This means that they're probably not attractive to, say, first home, to renters who want to live close to the CBD, mainly an older demographic, I would say. Positive cash flow properties can quickly turn to negative gear properties due to any market fluctuations and maintenance costs that are unexpected. Say someone smashes your wall, you have to pay for that, you might have to fork out some money, and that'll turn into negative gearing. Like I said before, most positive cash flow properties are located in rural or regional areas, and these are prone to slower capital growth, which reduces your access to equity, which isn't necessarily a bad thing, assuming that you're making as much money in cash flow as you would over the long term. Any potential gains from cash flow properties require you to pay tax at the marginal rate. Like I said, this is added to your taxable income and may force you up a tax bracket, meaning you pay more tax. So that's all for today, guys. Feel free to like and subscribe, and look forward to more property advice over the coming weeks.